Hey everybody, Josh Sigurdson of World Alternative Media here, and of course, as per usual, we are joined by John Thore, Stub, Sneisen, economic. What would you call yourself again?
Economic systems expert.
Yeah, he doesn't want to be compared to economists, and also an author of the book *The End of Freedom: How Our Monetary System Enslaves Us*. And we are also joined on the line over Skype, actually, by Russell Gray, and he's co-host of the Real Estate Guys radio show. This guy is a true real estate expert. He's co-authored the book Equity Happens and has been a great voice of warning for trends over the years. Russell, welcome.
Hi, how you guys doing?
Perfect. And thank you for joining us. And actually, John, can you tell us a bit about our guest? Because I know you met a lot of really great people through Freedom Force International.
Yeah, totally. No, I met Russ down in Paso Robles, California. He got introduced to Deirdre Griffin through some other things that Deirdre Griffin has been up to.
Mhm.
I talked to Russ, and right away I found out like this guy is a real expert on not just real estate, but he understands economics, which a lot of real estate people don't really totally understand, like the full macro picture down to the micro. Like Russ is really spot on with everything. He also was featured on the 2015 predictions panel that Robert Kiyosaki has, which is quite huge as well. So
Oh, that's
yeah,
awesome. So now, Russell, the markets are not looking good right now long term. It doesn't help that the fiat dollar is practically worthless. Is real estate or property an asset that can protect you from an economic crash?
Well, I mean, the short answer is yes. Anything real is going to hold its value relative to other real things. That's the whole concept of a real asset. Paper currency is exactly that. It's paper. And the big challenge for all investors, not just real estate investors, is they tend to denominate their wealth. They measure their net wealth, they measure their net worth, they measure their cash flows, they look at their savings, and they denominate it all in whatever currency they happen to be in. You know, in Canada, it's a Canadian dollar, US dollar. If they're in the European zone, it's the euro. But it's just paper. And obviously, we all know that those have different relationships even to each other. But if you strip out value from being denominated in a currency and you compare value to value, then yes, because if you think about it, if you have a three-bedroom house in 1950 and it costs $5,000 and it sleeps three people, 40 years later, if it's worth $500,000 or $250,000, it still only sleeps three people. So the value is the same. The price denominated in currency has changed. And as the currency lost value, the house retained value, which meant it took more currency to buy the same house. If you were to compare real asset to real asset, for example, that same house you might have been able to buy a car for $500 in 1950. And then you fast forward to whatever year you choose. If the house is selling for $250,000, you might be able to buy 20 more cars or whatever the number would be. In other words, relative to other things, it's still the same. So yes, it preserves value over time.
Absolutely. Well, here's the thing with real estate. It's something that I've always been really interested in, but it's one of those subjects that I've just never been able to educate myself to the full extent on. Whereas, with economics, I've been able to, like simple basic economics, I can figure out pretty easily. And I'm learning something today, so I'm really happy to have this conversation going now. I've noticed there's a lot of talk lately about these ghost cities in China, where they're building skyscrapers and full neighborhoods that no one lives in, and it kind of brings me to the question of, because of course obviously that's a communist country and it's a bit
yeah.
it's a little bit different obviously, but at the same time I wonder, will we ever see the kinds of ghost cities that we see in China in the United States or Canada?
Well, I mean, to some degree, that did happen. You know, back pre-crash, Las Vegas had a huge building boom, just to name one market, and they way overbuilt. And that's because you had a lot of speculative money, investors coming in, buying houses they had no intention of living in, and a lot of times had no intention of renting. They were simply buying to control the asset, hoping that, 2, 3 years down the road, it would go up 40, 50%. They would sell it and make a profit. That's pure speculation. And I have no problem with flipping houses. If you're going to buy a house and you do something to fix it up, make it better, you buy the worst house in a nice neighborhood, then you turn around and sell it. I call that forcing equity. That's what builders do. Builders buy a piece of dirt and they put a structure on it that wasn't there before, but it's all predicated on there being a takeout buyer. There's got to be somebody on the other side. And when there weren't real home buyers in the market, that's where the Vegas market collapsed. Now, China's kind of a different story, and I have a different take on it than a lot of people. You know, the basic concept of going into debt is to bring future dollars into the present. And if you knew right now that your dollars in the future were going to be worthless, if you believed that, think about what you would do as an investor. If you had credit lines available to you, you'd max them out and you would use them to go purchase things that are real, right? You would accumulate gold and precious metals as opposed to stacking up paper. If you had bonds denominated in that currency, you'd probably begin to unload those. If you were a major holder and you would be able to trigger a sell-off, you would do that slowly and carefully. So if currency were to collapse somewhere down the road, what would you have? You'd have a safe full of gold, and you'd have a bunch of property that's real. And your bonds would be worthless, and your bank account would be worthless, but you wouldn't care because you put it in things that are real. Well, that's exactly what China did. And then if you think about it, they lifted the ban on births, which means they're expecting a whole lot more people. Now, there's a couple of different ways. Some people, you know, communists, collectivists, people who view the citizen as a burden of the state, they want to limit population growth. People who believe that people are assets and they go to work and they produce and grow an economy, they want to add. The irony in this is that you've got China who wants to add people to their economy. Now, does that mean there isn't going to be short-term pain for China and the rest of the world? No. All transitions are different. I think as investors, what we have to do is recognize that we are at the end of a giant global debt bubble. It could burst today. It could burst next year. It could burst in 10 years. I don't know. I do know that history says that if you own things that are real and essential, that serve basic human needs, that people will get up every day and pay you a portion of their productivity to have access to that asset. Real estate is that kind of an asset. Gold is a proven store of value over time. So for my money, real and essential, I like what China is doing strategically, you know, and a lot of people are down on China. I don't know. You know, they don't control the world's money supply. They're trying to get control of it. Is their debt a problem? Sure. Are they going to put their people through a lot of pain making this adjustment? Yes, they are. But if the currencies collapse, you know, we're going to find out who the dummies were and who the smart guys were.
Yeah. And you mentioned gold and silver and physical value, and I have a bit of an obsession with that because you know I'm down on you know what's going on with the U.S. economy, the Canadian economy, basically economies around the world printing useless money. And you know, when I look at gold and silver, I see hope, as people have for thousands of years. And we will get to that shortly. And you also actually mentioned the kind of push for depopulation in China, and that gets on a whole other subject of you know what's going on with Agenda 21 and stuff along those lines. But I'm gonna move to I was wondering, what are your predictions for the U.S. economy and real estate in 2016 and going forward? Because you've been really good at predicting things to come.
Well, I mean, I don't know, you know, in terms of predictions, I just kind of, when I was a little kid, I used to play this game called Mousetrap. You know, I don't know if you remember it, but you drop this little ball and it would go through this series of events, and this would trigger that, which would trigger this, which would trigger that. And if you knew if you dropped that ball and everything went through its course, you knew that little thing was going to come down and trap the mouse. If you're the mouse and you understand the process, then you get out of the way. So my study of economics is not just some intellectual, you know, gee, this is interesting, but I'm trying to figure out, do I want to be there or do I want to be, you know, kind of over here? And I'm watching the mechanism. So to me, the predictions that I point are really just like, here's what is going to happen and here's why. For example, I've seen 35 years interest rate decline. I've seen 35 years of public debt growth. I've seen 35 years of the private sector debt growth. I know that you can only service so much debt with so much income, and that if you want to continue to increase your debt, which our system requires because we borrow our money into existence, then you're going to have to either increase your income and your ability to debt service, or you're going to have to decrease the interest rate load. Well, we flatlined on interest rate for the last 7-8 years. So lowering interest rates, I mean, you know, granted, Japan just went negative. You know, Switzerland had been negative. You know, German bonds, I think, had flirted with negativity. The U.S. has floated the idea of going negative. So the idea is people are going to get poorer. And notwithstanding the fact that lower energy costs are helping, you know, the working class person out there, I really feel that people are going to have to move to places that are going to be less expensive, that still have all of the amenities they need, the basic infrastructure, transportation, entertainment, shopping, obviously utilities and all those kinds of things. So, coming out of the recession and really studying what happened, because I got killed in the recession, honestly. I was a lot more speculative than I should have been. I didn't have a plan B. It was all, sunshine and unicorns. And then when it blew up, I realized that I was too myopic, and I took a big step back and started looking at the macroeconomic factors, and especially the bond markets, which feeds the debt that fuels the real estate market. I think the big story going forward into 2016 is going to be oil, and not the way everybody thinks it is. But if oil continues to be depressed, you've got to understand that there are a lot of oil bonds out there and derivatives placed upon those bonds. I've heard, estimates that it's at least twice as big as what the subprime crisis says. Last time I looked, there were over 30 companies that had gone broke. Chevron just posted its first loss in ages. So these are some of the most profitable companies in the world over the last few years, and now they're hemorrhaging cash. They're going to survive because they have strong balance sheets and they have the ability to make the adjustment. But in terms of the impact on the financial markets, which has a direct impact on real estate, I think that the oil story is going to be a big, big one in 2016. The last thing I want to say about real estate also, I've had this debate with Peter Schiff and some other folks. I've had this debate with Peter more than a couple of times, and it's a fun one because people like to refer to real estate as an asset class, and it absolutely positively is not an asset class. An ounce of gold is an ounce of gold anywhere in the world. I mean, there may be some differences based on the currency you denominate it in or what form you buy it in, but they're minor, right? A share of Apple stock anywhere in the world is the same price on any given day, right? But a piece of real estate is unique right down to the neighborhood, the condition of the property, the configuration, the ownership, the motives of the seller. It is so inherently inefficient. And if you understand that even within a metropolitan area like a Dallas-Fort Worth or Washington, D.C. or wherever you are, there are submarkets, and you can have markets that are in decline while other markets are growing. And if you understand what makes real estate tick, which is basically economics 101, you've got supply, demand, and capacity to pay. And a lot of that is rooted in the financial markets coming full circle back to bonds. And so if the bond up and everybody goes to trying to clean up their balance sheets like they did in the subprime crisis, credit markets will seize up, real estate will come crashing down, and that will be a great time to be a buyer.
Yeah. No, I do see that, and what I do think is going on as well is, especially in the microeconomic level, with real estate, you see like different places around our city that are like thriving, and then others are just dying off right now. What is also important is like a diversity of an economy. There's too many economies out there locally in different countries that are so based on one single commodity. Like I see back home in my home country, Norway, where we have a place called Stavanger. Well, they had over 80% of their economy was oil. Well, now half of the city is empty, and real estate has just plummeted, while real estate other places in Norway is going up. So, like people that talk about that real estate will go down or up, you got to understand that this is like real estate is a microeconomic thing, and even inside of a city, you can have a thriving and a dead side of real estate, right? So yeah, you're totally spot on, and I totally agree with you.
Yeah, absolutely. And actually, I wanted to kind of switch gears slightly to what your take is on the current international banking system, and would you like to see a change in the way people borrow money?
I think the world money system is a cancer that is destroying human potential. Because, if you really understand, my view on money is a repository of human life force. In other words, a human being gets up every day and they go do something productive to add value to the world. They convert a field to produce that can feed people. They convert raw materials to products that can house and transport people. And you can go much deeper into the technology that we're using today to conduct this interview that adds value to the world and makes it more productive. All human beings were involved in that, trading their time and talent, and in exchange for some form of money where they could store that value of their work until they were ready to go exchange it for something of value that they needed. Much more efficient form than barter. What happened when the banks got control of it is they found out that they could dilute human value and steal a percentage of people's efforts simply by printing money out of thin air. So on its face, it's immoral, it's evil, and then you add to that the concept of debt, where you can actually enslave somebody to get up and go to work every day and pay you interest on money you printed out of thin air. I mean, that's unconscionable. So the core in the financial system isn't we need to get out of debt. I have this debate all the time. Oh, we need to balance the budget. You can't balance the budget in this system. It's physically impossible. If you were to balance the budget, you would completely collapse the economy. There would be no form of currency exchange. You'd have to find something else to use. So at the core, the very core, the secret or the answer is sound money. When money becomes sound again and don't allow banks to create money out of air, then savings will have real value. And people who produce more than they consume and put that into a system, it used to be the banking system, that would then make it available to people. I have no problem with borrowing. The problem I have is with fake money. Mm-hmm. Borrowing the excess of a productive person in order to increase the means of production, to buy capital equipment, consolidate capital where it can do good in the society. I believe in all of that. And the person who did that work deserves a return on their labor. So I have no problem with interest. The core problem is the money is phony. And you've given people the ability to produce it without doing anything productive underneath it. Savings is the answer to formation, not printing.
Well, would you agree with the idea of, say, a completely free market system with competing currencies?
With competing currencies?
Yeah.
I don't know. I'm probably not smart enough to answer that question. I mean, to me, whatever form it needs to be, if all the currencies are printed, then you still have a basket of printed currencies. If we go to an SDR and it's just indexed to a bunch of currencies that are all printed, you still have the same problem. The thing that I'm opposed to is the ability for people to be able to, bankers, to be able to print money out of thin air. That's the problem, because now they are able to counterfeit human effort. You're stealing people's life energy, right? I mean, you're basically stealing people's lives. They've exchanged their time, effort, and talent to create value and store it, and it's an unsafe store of value. And that's why you have to look for alternatives. You have to look for alternatives for yield. It used to be that you could put your money out there and you had a risk premium for lending the money and you got paid interest. Today, there is no interest, and there can't be any interest because the debt load in society is so high that any level of interest, I mean, look at the Fed. They raised the stinking rate 25 basis points and the stock market just imploded. And that brings up a whole different discussion because people don't even understand what value is. There's a big difference in the value between, say, real estate, for example, which is, my investment of choice, versus stocks. Stocks are valued in some ways the same way homes are, and that is by comparative analysis. I take a sample. I might have a billion shares outstanding on a big corporation on any given day, maybe a million shares trade. So whatever that million shares traded for is the price that everybody thinks that on their balance sheet the rest of those shares are worth. But not really, because if everybody went to go sell those shares and there was 100% absorption, the price would come way down. And we just are so used to that being the way prices are set, we accept that. So when we hear, the stock market went down 20% and trillions of dollars wiped out, those dollars never existed. That was just on paper. That was just a paper evaluation. So with a house, if I look at a house and one house says, if you got 10 houses and they're all exactly the same, in an economy that, say, got $1 million, just to keep the math super simple, you've got 10 houses and you've got $1 million of available money. On average, if every house is identical, each house is worth $1,000. What if for one day somebody wants, they decide to pay $200,000? Well, out of $1 million available, there is $200,000 to buy that one house. So they buy it. Well, then what does every other homeowner on that block thinks that house is worth? They think their house is worth $200,000. They have $100,000 of equity. Well, the problem is there's still only $1 million in the economy. So you get $2 million of product valuation against $1 million, and then some event comes and somebody's got to sell a house at a fire sale and they sell it at $100,000. Or if everybody were to sell at one time, it's $100,000. Everybody loses the equity or loses that value that never existed. It was air. So when people talk about bubbles, they talk about air. People hear the term, but they don't know what it means. That's what it means. Now, if you think about real estate is valued, income real estate is valued by the income it produces. And if you were to go look at an apartment complex, big area where there's a lot of apartments, and there's 10,000 apartments, and there's 95% absorption, meaning 95% occupancy, that means the buyer, the tenant, is paying a rent based on market forces, and the seller, the landlord, is selling the use of the property for that month based on market forces, and they agree upon a price. That's the real price. There is no fire sale because you can't add another 10,000 units, right? That's basically full absorption. So when you're buying real estate the right way and you understand that it's valued by the income, that's why if I was going to be a paper asset investor, and I'm not, but if I were, I would definitely focus on income producing stocks, dividend paying stocks, as opposed to speculating on buy low, sell high. I don't believe in that.
Yeah. And you mentioned the Fed, and I can't help but be that guy that kind of sounds like these conspiracy theorists when I say it just seems like they're doing this kind of stuff on purpose, though, at the Federal Reserve. It's unbelievable. Nobody could be so stupid to do what Bernanke and Yellen have done. And before that, Volcker, and before, Alan Greenspan, it's just unbelievable that anyone could possibly think that this kind of economic central planning is a good idea. It's just insanity.
Yeah, because that's what it is. It's full central planning. That's what a central bank is, and you can't have that in a real good economy.
No,
Look at Venezuela right now.
Oh, Venezuela is looking at hyperinflation right away. It's unbelievable. And people think this can't happen here. Well, look how fast it happened in Zimbabwe. It was like 1 year, 2 years, and it hit $100 trillion.
That's usually how it takes. When a currency fails, it's usually within a year to two. Like, it's nothing more than that. So happens so rapidly because it's only a trust in that currency that it has value that gives it value. So when people lose that trust, it happens quite rapidly.
Yeah. And well, now, Russ, I'm a lover of physical preserved value. What are your future prospects for the gold and silver markets? And when about will the next big jump be, considering the 2002 to 2012 rise in value?
I pay a lot of attention to gold, but maybe for not the same reasons. I don't look at real estate as a vehicle to produce paper. A lot of people use real estate to produce paper. I flip a house, I make cash, I put money in my bank. I don't have that desire, right? So I don't look at gold as a tool to produce paper. I'm not interested in buying low and selling high. What I'm interested in is a place to store my value long term. So somewhere down the road, if I want to use my savings for a purpose, maybe buy more real estate income. Because really, I want to buy income. That's what I'm interested in. Gold doesn't produce income. It's just a place to store value. So, right now, I mean, if you really think about what's been going on with the metal market, there's a couple of issues. There's a giant tug of war going on between the paper markets and the physical markets. I follow the COMEX inventories, as I'm sure you guys do. I watch what goes on in the paper markets with respect to the way the speculators roll over their contracts, how many claims there are to each available ounce, the movement between eligible and registered, and all the things that all the gold bugs pay attention to. But I really don't care what the price is. 3-bedroom, 2-bath house at $5,000, 3-bedroom, 2-bath at $250. I didn't make any money. I preserved my wealth, but I didn't make any money. I make money when I add more units of real value. So when I look at gold, look at how many ounces are in my safe or on my balance sheet. Silver, the same thing. I don't care what it's valued at in terms of dollars, because that doesn't matter to me. I mean, if that was true, then, I could move to Zimbabwe, as you mentioned earlier, and be a trillionaire. It really doesn't matter. So, as far as that, I mean, do I expect it to go up denominators over? I do. Here's what, I'll just give you a little example, because you mentioned Zimbabwe, we're talking dollar, we're talking about precious metals. And I have a way I explain to people what I think is going on. And I've run this by a couple of currency experts, and I've asked them, poke holes in this if I'm not seeing this right. But, because I'm on the radio, because I teach seminars and I coach people, I try to find ways to explain things that people who really are not familiar with the concepts, kind of at the granular level, can grasp. And so what I do is I say this. Imagine, you've got, you can see my hands in the picture, right? Imagine this is sea level right here. This is sea level. Everything below sea level is you're wiped out, you're drowned, you're underwater, it's over, right? Above, you want to be above water. So what you've got is a boat. And in the back of the boat, you've got Zimbabwe currency. And in the front of the boat, you got the US dollar. Now, you can order every other currency in the world any way you want, but this is obviously the weakest currency, and this is we're going to call the strongest currency, the world's reserve currency. On the side of the boat, you have these little dinghies called precious metals. And what it is as these currencies begin to fail, and currencies around the world that begin to fail, the ship begins to sink. And as it begins to tilt up, everybody is scrambling to the dollar for its safety, and they're running right past the dinghies. And then they're arguing about rearranging the deck chairs, and we need the blue captain on the ship, we need the red captain on the ship, we need the orange-haired guy on the ship's sinking, right? And they're all about that. Meanwhile, guys like me are getting into the boat. We're getting into the dinghies. And the fact that the dollar went up and made it easier for me to step into the boat instead of having to climb up, I was able just to drop down in, sell the dollar high and buy the metal low, right? But then when the ship starts to sink, guess what? When that hits the water line and the currency goes under, those dinghies will float. The problem, if people wait too long, those boats are going to be full. A ticket's going to be expensive if you can even get one, because there's only so many dinghies or life rafts on the boat, and that's the way it is. I mean, when you look at the number of people in the world and you look at the number of ounces in the world, there's just not enough to go around. So again, to answer your question, when the light bulb goes off for people and there becomes a scramble for real money and people give up on the funny money, and I don't know when that's going to happen. When that happens, you're going to be happy that you own precious metals.
And you hit the nail on the head there. I mean, talking about preservation of value, for example, I mean, if you go back to the 1910s in the United States, people were getting, the silver coin every hour, and that's equivalent to about 17.50 now an hour. And people are talking about, oh, well, we need a wage hike, we need, more. Well, let's look at the money and let's see how that money works with inflation, how that money works with preservation of value. Because yes, it's not just about investing; it's about being able to have safety when things go wrong. And we know things will go wrong as long as we have a dollar that's so weak. And I mean, do you think that we need to allow the dollar to crash before we can make things better and be able to build again from scratch at a more free level?
Well, I'm not really a policy guy because last time I looked, nobody's looking at politicians. Worry about policy, just like about the motives of the central planners. It really doesn't matter. If you think about it, if you're locked in a room with an elephant who's big enough to crush you, it doesn't matter if the elephant hates you or doesn't even know you exist. You better pay attention to that elephant and respond to its movement. And I call, the Fed the elephant in the room. But a lot of us spend time trying to figure out how to change the elephant. We want to understand the elephant. We want to manipulate the elephant. We call the elephant names. Meanwhile, we're not taking the defensive strategies we should to put ourselves in a position to react quickly to whatever it is the elephant does, regardless of its motives. I don't have any control over policy. I mean, what would I like to see us do? I would like to see us create a plan to get an orderly move towards sound money. I believe sound money is unsound money is the leukemia of the economic system. And we are never going to be healthy. We're going to have tumors popping up all over our collective, economic body as long as we allow the cancer to exist. And we can cut the tumors off and we can go get radiation and we can, do all those things that people do, when they have cancer, but they don't deal with the core issue that they have cancer and the thing, what's feeding the cancer, what's causing it. I've got to eradicate the cancer. The cancer is unsound money. And so I would love to see policymakers address that issue. And when you're this far down, it's going to be a difficult transition. It's going to be a lot easier for people that understand the problem and to put themselves in a position so however the problem manifests, you're okay. I don't have a problem holding dollars. They've actually been strong, and they might get stronger because as that ship sinks, it's going to go further up maybe before it goes down. That's okay. That means I'll have some dollars so that if the metals continue to stay suppressed, I can dive in and buy more. Because again, I'm not interested in denominating my net worth in dollars. I'm interested in denominating it in tenants, properties, ounces, barrels, anything real that's essential. So I like commodities, I like metals, I like real estate, and I like income producing real estate.
No, what we see around the world is a move, and this happens every time they go to a fiat currency. is the change when people actually are going from secure debt, like actually lending money against and some money, lending some money against business, real estate, something that actually produces something and innovates something, to a move to unsecured debt where we have the derivatives world. We have people dabbling in real estate without what you said, like they don't care about, like they just want to make the dollars. And then suddenly they don't see that they like bought a house for 100,000 over the valuation, and then suddenly market drops. Also, the unsecured debt is like not really backed by anything other than other paper. So this is like usually what happens at the death of a currency is when paper creates more paper, and they don't need the workers, they don't need people like you anymore that like want to create real value, or the innovators that like really create great things and make our society move forward. It just destroys the whole world, this whole paper Ponzi scheme. And what you end up with is worthlessness all over the place, and people ending up like the Roman Empire, where you've got breads and circuses, where people like want entertainment, like from the NHL or the Super Bowl coming up and all that stuff. And then they want the government to give them freebies, like through the food stamps or the welfare here in Canada.
Yeah. Debt slaves everywhere. And I'm pretty sure, you in the United States and us up here in Canada can probably relate on that front. And, speaking of, debt slaves, so what do you think about, going forward in, the markets in the United States? Which place is the best place to buy? Which state? And which state is the worst place to buy?
What I look for when I go looking for a real estate market is I look for a business-friendly state legislatively. I look for a state that is friendly from a tax perspective. There's 7 states of the 50 that are no tax states. You have to look for quality of life because people care about quality of life. They care about the weather, they care about things to do, entertainment and whatnot. Most of the time when the world is changing and people can't find work, they've been taught all their life, go to school and get a job. And so when they can't find it, they think they need more school. So I like marcational infrastructure because it attracts people, and people tend to go to a place that they went to school, and then when they graduate, many will settle there. And so that's what I call a kind of an attraction, if you will. It pulls people in. We look for migration patterns. Are more people moving in than moving out? We look for affordability. I really believe people are going to be have less disposable income. So these states can only go to help them out. I'm not thinking the oil is going to go too much. And so they're not going to get the energy kick. They've already been slammed on health care. And unless we fix that, it's just going to get worse. So you've got these issues. Now, one of the things that's interesting, though, is that we have the baby boomer generation here in the United States, and those people have portable paychecks. They get their benefits, their pensions. And so, we don't necessarily have to look so much at marketplaces that would be attractive to people who are looking for jobs if you're interested in investing in bedroom communities. You just got to be careful about that. The other thing is geographic economies. So we were very high coming out of the 2008 recession on oil industries. We felt like obviously oil was low, and we felt like it had the potential to go up. It did. Most of the net job creation in the United States came out of the energy sector from 2008 to 2015. Sadly, we're getting a lot of job losses in that sector right now. But those were geographic. You couldn't, if you're pulling the oil out of the ground or the natural gas out of the ground in a particular region, you can't export those jobs to, Mexico or Asia, right? You've got to do that right there. And that creates real work right there. The other thing we look for is cones, things that pull money in from outside. So I say it, but if you were buying on a buy low, sell high basis, Washington, D.C., been a great market in terms of that. Lousy rental market, lousy landlord-tenant laws. So part of the markets you pick have to be what you're trying to accomplish. I like to buy places that are landlord-friendly. So I would never own income property in Washington, D.C., or New York, or San Francisco, or even California for that matter, even though they've had great appreciation in real estate. The economic hubs, Wall Street, or the been a big feeder of the driving of the values up, especially in the San Francisco Bay Area, plus tech, and that gets sold all over the world. So these primary drivers pull money in from outside the world. The other one, though, is distribution. So some of the markets we've been high on have been Memphis, which is the home of FedEx. It's right on the river. It's been a big shipping hub for a number of years. It's a blue-collar town. It creates a lot of working-class jobs that people who rent. And so it's been a great rental town. We've been there for a number of years. We like Atlanta, Georgia, big shipping hub, UPS hub, home to a lot of Fortune 100 companies, very affordable. Georgia's not a no-tax state, but it ranks very highly as a tax-friendly state, and it's part of the distribution hub. Stuff comes into that Savannah port and then comes up into Atlanta and gets dispersed, so we like that. Dallas, Fort Worth. Not only is it an energy town, it's a very, very diverse economy, probably the strongest economy of any metro in the United States. But it's also the first major distribution hub on the NAFTA highway. So the NAFTA highway comes up through San Antonio, and it basically terminates in Dallas, which has a giant airport, giant trucking, central to the United States, can deliver goods all over the place. And so we've been very high on all Texas markets, but especially DFW. So right now, Central Florida, the Orlando, Tampa, St. Pete market, we like Florida as a no-income tax state. It's a big popular state for retirees from the Northwest. It's got the largest convention business, so it gets exposed to a lot of people. People come there, maybe they're looking there. They come and they stay there for a convention, and they look around and they can see that there's good quality of life. People who would want to have maybe a lower price warm weather thing. Las Vegas is the other big convention, but Las Vegas has a different connotation. So I think that Central Florida market is going to be a very strong market going forward, especially with retirees, but also with business. And again, being a convention town and entertainment town, plus there's a lot of other diversity in the Orlando market. You create a lot of working class jobs, people rent, and the numbers make sense. You can buy homes, buy apartment buildings that cash flow. I love that market as well. And there's others. Right now, these markets are no longer secrets, and they're getting bid up as people are chasing yield, and they're looking at real estate as a place that can produce yield. So they're going into these major markets. So now we're looking at secondary markets. Indianapolis, St. Louis, Kansas City. These are marketplaces that aren't the A-list marketplaces in terms of desirability. But John Burns Consulting is one of the information services that I follow, and he caters to the building industry. He feeds them information, and he just affirmed what I thought was going to happen, which is people are gravitating towards more affordable cities. And so that's a note to the builders. Hey, builders, you should be being prepared to go build in these more affordable cities. So I think we're going to see more there also. So the next 5 to 10 years, that's what I would see happening. We'll see.
Well, I mean, you're probably asked about this quite often, but I have to ask, will we ever see a recovery in the real estate market in Michigan?
Well, Michigan has a lot of things going against it, and it's a poster child if you ever want to study what not to do in terms of running an economy. Michigan obviously was one of the most richest, most robust economies in the world. Detroit at one time was a 2 million person population. It was the richest city in the world, and Detroit then soon, because of bad policy, ultimately became the biggest city to ever go bankrupt. And now what's left is all producers have left, and if you've ever read Atlas Shrugged by Rand, that's exactly what happened there. And you've got the takers, the looters, if you will. Now, I'm not putting down Michigan. Don't get me wrong. There's good people there. But again, just painting with a very broad brush, the unions and unions served a purpose. I'm not anti-union, right? But the problem is when you put too much load in terms of social obligations on a commercial enterprise that's competing on a global scale, then you have a disadvantage. And maybe through reputation and brand and strong business practices and efficiencies and maybe wise financial management on your balance sheet. You notice that a lot of the auto companies to survive quickly moved into finance because they could make more money on the finance than they could on the cars. They literally give the cars away to create the paper. Well, when something's wrong, right? And you can see the writing on the wall. But it takes on a life of its own, and then pretty soon it becomes what it is. Now, with that said, they probably are only a few policy changes away from creating a friendly environment. And again, I look at economies like organisms. And if you have bad health practices, you're going to get sick. You're going to get fat. You're going to get fatigued. You're going to get clogged arteries. You're going to get high blood pressure. But if at whatever point in your life you decide to clean that up and you start eating right and exercising right and hydrating and doing all the things that you're supposed to do, much of the damage that was done during the bad habits can be reversed. I believe that's true economically. Could Michigan come back? Absolutely. Will it? Only time will tell. If it does, people who are studying that market, watch them start to make those good decisions. It would be a great time to get in. For my money right now, there are so many other places to go. Definitely not on my short list.
Yeah, and I kind of always make the metaphor that imagine a whole bunch of people holding up, a ceiling, and the bigger the government gets, the more way down that ceiling gets, and eventually the markets underneath it and the people that are holding this up are going to get crushed underneath it, and it always happens every time we grow government too big.
We do
and
see
too
this
much
in,
red tape.
we do see this in all over Europe right now. I look at government expenditure as a part of GDP, and there's over 10 countries in Europe right now, and it's the poster childs that are suffering from massive government austerity right now. It's Spain, Portugal, Greece, Italy. All of these countries, they have a way too big government, and they're suffering. And this is it's a government cycle. You always would end up when you go into the collectivist realm to want to have more control, more laws, and so on. And then it just ends up toppling in on itself when it's unsustainable, when we as productive human beings in the economy can't give it enough money from ourselves anymore to feed the big beast, which is the economy, which is not the economy, the government.
Yeah, and it's tragic. It really is tragic what happened to Detroit and what happened in Michigan and in a lot of other places. I mean, this is kind of starting to happen like a domino effect across the world. And I mean, yes, it's sad, but at the same time, there's people like us out there for a reason, right? And Russell, I can't help but mention you've had some incredible people on your show in the past. I mean, you've had Robert Kiyosaki, you've had Donald Trump, you've had Steve Forbes, and you've had so many people at the top of their field and that really know what they're talking about. And it's quite incredible. How can people find and support the work you do?
Well, you can find our podcast, which is free on iTunes, and it's probably the easiest place to find it. You can go to our website at realestateguysradio.com and subscribe to the podcast. If you send an email to newsletter@realestateguysradio.com, then you can get on our news list. Every week we publish a podcast. We send out an announcement. I usually write a commentary with some type about what I see going on and what it means to real estate investors. We take a lot of pride in studying what's going on economically and try to help people interpret the news from a real estate investor perspective, because most of the people who are out there commenting are servicing their audience, and I totally get that, right? I mean, if you're on financial TV, you're talking to paper asset investors. If you're talking about real estate, you're talking to homeowners or people who are investing in home builder stock. You're not talking to people who are owning and operating income producing properties and having to look at managing debt and equity and cash flow and market selection and demographic selections based on what's going on in the news. I haven't found anybody out there really talking to them about that. Most people in the real estate space are all about how to flip a house or how to do Section 8 landlording or, read a termite report. All that stuff's valuable. I'm not putting it down. But I'm saying that your real estate portfolio is floating in an economic sea. If you don't understand the winds of change, if you can't read the waves, then it's awfully hard to navigate. Sometimes you get capsized. I know it happened to me, and that's why I do what I do, and I'm a lot more intense about it. You mentioned all those great guests we've had on the show. We started seeking out people that were a whole heck of a lot smarter than us because we realized that we could no longer be the smartest guys in the room. We had to go find guys that were way bigger than us and get a 360 and look at things that we hadn't even thought about before. And it's been a ton of fun. And you know what I found out about those people? They're very gracious. They're happy to share their time and share their wisdom. None of these guys need the money, but they do it because they see some things wrong in the world and they're trying to get the word out. So I appreciate what you guys are doing and giving me an opportunity to share some of my thoughts with your audience, and encourage you to keep up the good work.
Absolutely. Thanks,
Thank you.
Russell. And that's exactly what we're trying to do. We try to get people that might know a lot more than us on certain in certain areas, and to be able to explain that to us. Because I mean, we all have to live and learn, and we need to listen more than just talk sometimes. I mean, a lot of problems with a lot of medias out there are that they just talk, they talk, they talk, they don't listen. And when you bring on people who are experts in their field and you truly listen, you get a grasp of what's going on. And you talk to people from all sides, and I think it's really incredible what you do. And I thank you for coming on our channel here. And I wish you well with your show. I urge our viewers to check out the Real Estate Guys radio show. Check out his book, Equity Happens, which he co-authored with. It's a Real Estate Guys book. Great read, and thank you very much, Russell.
Thank you. Thanks for having me.